Hey everyone, welcome back to our channel. Today we're diving into a topic that affects us all. Money, how does that word make you feel? Is it a rush of adrenaline, pound signs running through your head like a slot machine? Or maybe you feel motivated, ready to send those work emails you've been putting off? Or spend an extra hour writing that movie script you're certain will be a hit? But maybe you don't feel so good when you hear that word. Maybe the mere mention of money causes your hands to go clammy, your heart rate to rise, and your brain to start doing somersaults around all the ways in which you don't have, need more, or want more money. Whatever your response to the subject is, we all have one. Because as they say, money makes the world go round. Whether it's your £5 coffee every morning to start your day or the £3,000 loan payment you just made, not a day goes by for most of us that we don't consume, spend, study, or merely think about money. You could be the driver of a sports car wearing a diamond necklace or the homeless person who watches that car drive by. On one level or another, money matters to us all. Economic world spinning. Contrary to what you might think, money as we know it today, at least in its physical form, has remained largely unchanged for millennia. The first sign of what we might think of as a banknote took the form of a piece of leather in China in 118 BCE, and 900 years later, paper currency came to fruition. It would be another several hundred years before this kind of currency would make its way to Europe and then the rest of the world. Centuries have now passed, yet the basic concepts invented by the Chinese aren't that distinguishable from what we have today. The real evolution lies in what these notes and coins represent. The first real global system of valuing currency was the gold standard, which began in England in the early 1800s. It tied a currency's value directly to the established value of gold. So, in a country like the United Kingdom, £1 was pegged at exactly 1/50th an ounce of gold. This system was set up in such a way that ideally it would provide a stable monetary environment around the world. And it did for a while, but as with all natural resources, the supply of gold was not as fixed as we originally thought. As a result, countries began dropping it as a means to measure the value of the money. In 1971, the United States officially severed the convertibility between dollars and gold. By that time, the US dollar was seen as the global standard currency. So once the dollar was no longer dictated by the value of gold, pretty much nothing else was. Without a commodity like gold backing it, what exactly gives money its value? The answer is confidence, supply, and demand. And with that, we introduce the invisible force that affects all of us: inflation. Inflation is essentially the rate at which the purchasing power of money decreases over time. A pound today doesn't buy what it did 50 years ago, and that's because inflation steadily increases prices. When central banks, like the Bank of England, inject too much money into the economy, demand increases and prices rise. A moderate amount of inflation is considered normal and even healthy for economic growth. However, when inflation spirals out of control, wages often fail to keep up with rising costs, which leads to financial strain for the average person. Governments try to counteract this by adjusting interest rates, raising them to cool down inflation or lowering them to encourage spending. Which brings us to the topic of debt. Around 80% of people in the UK are in some kind of debt, yet many don't fully understand how debt functions in the larger financial system. Debt isn't inherently bad, it fuels growth, allowing businesses to expand, individuals to invest in education, and governments to fund infrastructure. But when managed poorly, debt can spiral into a burden that outweighs its benefits. The rise of buy now, pay later models, credit cards, and high-interest loans means many of us are living on borrowed money, often without a solid plan for repayment. And this isn't just a personal finance issue. Entire economies run on debt. Countries borrow to fund projects and stimulate growth, but excessive borrowing can lead to crises. If a country can't pay back its debt, it risks economic collapse, which then ripples across global markets. Which brings us to how the global economy ties into all of this. When you buy a product, its price is influenced by countless international factors: currency exchange rates, oil prices, trade agreements, even geopolitical tensions. If inflation rises in the United States, for instance, the Federal Reserve may raise interest rates. This, in turn, affects the value of the US dollar, which then impacts trade, stock markets, and borrowing costs worldwide. This interconnectedness means financial decisions in one part of the world can have unforeseen consequences elsewhere. A housing market crash in the US contributed to a global recession in 2008. A war in a major oil-producing region can send fuel prices skyrocketing worldwide. Even a single bank failing can send shockwaves through global markets, as we saw in the 2008 financial crisis and again with bank collapses in 2023. Understanding money is about more than just knowing how much is in your bank account. It's about seeing the bigger picture, how personal finance, national economies, and global markets are all interconnected. And the more we understand this, the better equipped we are to navigate the financial system, whether that means saving wisely, investing strategically, or simply making informed choices about debt and spending. So, next time you tap your card for a coffee or check your paycheck, take a second to think about the invisible forces at play. Money isn't just about what's in your pocket. It's a vast, complex system that shapes our world in ways we rarely stop to consider. Until next time, stay informed, stay smart, and make your money work for you. If you like this video, please hit the like button and subscribe for more content. It really helps the channel grow.